Hey, good afternoon, everyone. Welcome back to the live stream. We have closed the market for Wednesday, October 30th. And again, we had some pretty big earnings announced. So I wanted to go over earnings, some big companies, and also some smaller companies. One that I forgot to cover yesterday. So I wanted to catch up. It's a stock that I own. And it is a small cap. So we got to give some love to those small caps. Thank you so much, Shadow Guy, for attending. I hope you're doing really well. I hope your stocks went up and it went up nicely. And Android PC, very good to see you. I like the little ghost. It is the season for Ghosts and Goblins, and hopefully you're setting up to have a really nice Halloween. I am. I've got my costume. I'm ready to go to a party I was invited to. It should be a lot of fun. So the market, uh, it was interesting that the market opened up nicely this morning. It was in rally mode, and then it faded. It started to fade, throughout the day, and then it ended with the Nasdaq going down, the S&P and the Dow all going down, as well as the Russell. Overall, the market did sell off. I have Google Alphabet as a stock, and that did well today. And so did Ali. Ali's been rallying. It's a stock that I've recently covered. Then another winner for me is Care Trust, which I'm going to cover in detail because it's a small cap, but it really did well. It announced yesterday, and it's doing really well. It's got its unique proposition as a real estate investment trust. It's making lots of money, paying good dividends, and appreciating in value. I'll cover that a little later. So this is the week where we just have big announcement after big announcement. And I'm going to start with one of the biggest stocks on the exchange, and that's Microsoft. And Microsoft is a $3.2 trillion company. Man, that is a lot of money. And early on when they announced, the stock was trading up. Now the stock's selling off a little bit. Might be that the market itself is selling off a bit. It feels like some people may just be leaving the market a little bit till maybe after the election. Maybe that's the case. I went over Microsoft's earnings and I did read through the earnings, and I'm going to cover it. In general, I thought the earnings were very strong, very good. Now, some analysts might pick a thing or two that looks bad. I don't see anything worth picking apart. I think the company operated really well, and I'm going to go over that. Just some fundamentals, of course. It's a big, massive cap, but even having such a high price, it's still a PE of 36 for a really powerful, strong company with a very strong competitive advantage in the marketplace. Doesn't seem out of reach. I mean, I've been covering stocks that have PEs of 80, 90, and they're nowhere near as powerful, as strong as Microsoft. So 36 looks okay to me. It's a really, really good company. And next year, it's supposed to get even better at 32.9. It's a strong buy by analysts who say it's a little bit discounted. I'll share with you where I value Microsoft in a little bit. Overall, the stock's been a winner. For the last 5 years, it's up 202%. I owned Microsoft for a long time, for like 10 years, and then I sold it. I haven't participated in the last couple of years of appreciation. Congratulations to all those stockholders of Microsoft who have done well with the stock. It's been a good one. Over the last year to date, it's done 15%, which is good. It's a good return. It's just not appreciated as much as in previous years when it was where they were go-go years. All right, so looking at their earnings, really, they announced an overall revenue increase by 16%. This is a massive company. To grow 16% is quite incredible. And they did it, 16% growth. They grew. Their best growth area is their cloud business. They grew by 20%. That was very good. The cloud business is where companies go to, in essence, get services for infrastructure, get services to use the products over the cloud, things like AI services and things around the data center. So that part of the business did really well. You saw that Microsoft spent more money in capital expense, I imagine, to put more GPUs and servers and technology in that data center to help customers with what they deem to be the technology they need to use to run their businesses. So, in general, I think 16% growth on the top line is excellent. Great job, Microsoft. Other things that I would note is their cash flows were good, but cash flows for Microsoft and Google Alphabet and Meta, which I'll cover in a bit, they're a little bit lower. And that's because they're spending more capital in building out that data center. And that temporarily isn't going to be a problem. But if they don't start seeing revenue from AI and seeing profit from AI, the excessive capital expense is going to get old with investors quickly. Investors want to see a return on capital. And right now, I don't think Microsoft's going to be punished too much, but eventually they will be. So they got to start showing that, hey, we truly are selling AI solutions. We truly are selling AI, or the AI applications we're putting out there are working for businesses and consumers, and they really like them. Looking at their financials, Microsoft is a top 5 company really in the marketplace. They've been a strong grower each year, just very good growth for the last 6-7 years. Very good growth. And their cash flow is also very good. Now, I've done the analysis on Microsoft, and let me share that with you. So I've updated all my numbers, including, the cash flow, and I use last year's fiscal year as a full year, and I'm growing cash flows by 7%. And that is, I think, realistic for them. They are burning more in CapEx, but they are generating more cash from operations. So it's not a one-to-one offset. I think the burning of CapEx is a little higher than their growth in operating cash flow, but it's pretty close. Overall, I can't get to the valuation of Microsoft using free cash flows. I actually get to a premium of 27%. If I try to value the cash flows I expect from Microsoft and add the cash and take away debt and compare it to their current market cap and so forth, I get to about a 27% gap between where I think the value's at and their stock price is trading. When I use the earnings per share to value the company, I do get a discount of 22%. The earnings per share is very good. Now, I trust free cash flow much more than earnings per share. I take 2/3 weight of that number as I value the company, and I blend the two. So overall, I think Microsoft is being sold at an 11% premium. Not a huge premium. It's a great company. It's worth holding in a portfolio. I don't own Microsoft. I think you need to pick between Coke and Pepsi. You need to pick between two rival competitors. And the two rivals that I think are comparable are Microsoft and Google Alphabet. They do very similar things. They also do some businesses that are a little different. But I've picked Google Alphabet as a company that I think is going to appreciate more in the future and is going to be worth more in the future. I don't think owning both is a good idea. And that's why I don't own Microsoft. So that is Microsoft for you. I see some comments out there. Yeah, so it looks like Android PC, you think they're a good company. So you like Microsoft, that's cool. And HIMS is down. Okay. And then we got Tesla, SoFi, decent profit. Yep. Yeah, we covered Tesla last week when they announced. And SoFi, boy, that was a surprise how much that stock dropped. Um, but we covered those there. Looks like Shadow Guy. He chose OHI over CTRE. Both performed well today. Very good. That was interesting that OHI, CTRE, and another REIT that we covered performed quite well. Um, I think the REITs are with lower interest rates, that's going to help them. If the REITs are in the right business, that's going to help them. So I know that I'll cover Care Trust in a bit, but I'll get into the business they support, which I think is a really good idea. Okay, so we went over Microsoft. That was one of the big ones. The other big one was Meta. And Meta, I read through their earnings announcement and it's trading down. Now, Meta's been doing quite well. For the last month, it's up 4.3. Year to date, it's up 67%. Over the 5 year, it's up 200%. But really, when you measure from the low point in 2022 to where they're at now, it's up more than 500%. So Meta stockholders are doing just fine if you look at the last 2 years. A sell-off of 2.64%, not a big deal. I read through the earnings, and more importantly, I think the company is as strong as ever. Revenues increased, active users increased. What I didn't see in there that I hoped to see, and I'll probably listen to their earnings call, is more comments on their Meta.ai business. I really have liked that application. I think it's really good. I think it's very competitive to ChatGPT or Google Gemini. So I'd like to get more details on that. Meta is a big cap, $1.5 trillion, and their PE is a little better than Microsoft at 30. And then next year it's going to be 26. That's a really attractive PE for the dominant player in social applications that continues to grow their business. And when we look at their earnings, the company grew their top line revenue by 19%. Once again, Meta performed really well. To take a company that's this big and grow at 19%, that's phenomenal. More importantly, their income from operations increased 26%, showing that they expanded revenue far more than their cost. It's very good. So in general, I just thought very good earnings. Net income expanded by 35%. And when you look at all their metrics, daily active users, this number, right, is never lost on me. In the month of September, 3.29 billion users, daily active accounts. So that's a lot of people logging into a Meta application. And I think it gives them the network power of introducing a next application like Meta.ai. So I think that is a really good opportunity for the company. And I see that AI business is going to get introduced to all these users, and it's probably going to do quite well because I've used the Meta AI platform. I've used ChatGPT. I've used Gemini. I've also used Copilot. And I would say that they're all similar, but the one that has probably provided the best information and best answers has been Meta AI. And it was a little bit of a surprise because Meta was not in the conversation 2 years ago when ChatGPT was all the craze. But now they are most definitely part of the conversation. And Meta also provides their large language model, which they've named Llama, to other developers of AI so they can have a piece or participation in future AI applications. So overall, I think the power of Meta, the strength of Meta, the competitive advantages of Meta are still there, very strong. So I think their earnings is very good, very good. And if the stock tomorrow opens up 3% down, I will buy probably a share or two. I already own a lot of Meta, so I have to be careful not to buy too much. I'd have to diversify. So that's Meta. It's a fabulous company. Love what they've been doing. Really love their AI business. I love their dominance, and we'll continue to buy shares. All right, so we talked about two humongous companies. Collectively, they're almost $5 trillion in market cap. So let's talk a little bit about a small cap. and we're going to talk about Care Trust, which is a real estate investment trust that just has a market cap of 5.6 billion. Nice little company, and they do have good revenue. They've been growing their revenue nicely, and they pay a nice dividend, which they can afford. They're paying out roughly about 75% of their funds from operations in this dividend. So all that is healthy. Now, one pleasant, and I'm going to call it a surprise because I don't expect the REIT to do this. They've appreciated 53%, and it sounds like Shadow Guy is in another REIT, OHI, that's had a similar trajectory. But you look at where the stock's been, it wasn't really obvious that it was going to do that well. So I've been collecting my shares. I haven't bought in shares in a while, and I'm sitting on a really nice gain with this stock, and they keep paying me that really nice dividend. So I'll take it. This is in my book, a lower risk stock that's going to really perform well. And part of the reason that I think the company does really well is they're really focused on providing properties that will house the elderly that have money to buy for or the benefits, healthcare benefits, Medicare benefits, so that they could go into a facility and live temporarily or long term if they need some care, nurses care, doctor visits in their, in their dwelling and so forth. And it's really been a successful recipe because there's a lot of people that have gotten to the age where they're quite a bit older, their health is failing, and they go live in one of these places and they live comfortably and are able to, live there for as long as they need to, as long as they can afford it and it's in their benefits. And the property operators do quite well. And in turn, Care Trust does really well. So it's been a good holding for me. And the company has been operating really well. Their revenue, if you look at the trailing 12 months and the information's already made it to stock analysis, you can see that they continue to grow. And they're growing organically, I think, through price increases as well as they acquire new properties. But they don't acquire, massive new properties. I think it's mostly organic and really nice revenue growth over the years. That's really good to see. Their funds from operations, I believe we can see that down below. You can see that it's been a little spotty a couple years ago, but the funds from operations has been going up. So overall, they can afford that dividend. They're paying about 75% of that dividend. And real estate investment trusts tend to need, or I think they have to distribute most of funds from operations in order to continue to be classified as a real estate investment trust. So overall, this has been a good stock and, not a bad idea. We're sitting on really good gains. If you look at the NASDAQ over the last couple of years, it's just been great. You look at where we were in 2022 to where we're at now, just in the NASDAQ overall, up 80%. So that's great, great, great returns. Now I'm keeping my Meta, my Google, Alphabet, Uber, and all those companies that are in the NASDAQ. But it's good to diversify into companies like CTRE that are going to give me more stable upward appreciation with some income. Not a bad idea. Keep holding these stocks that have been doing great, but start diversifying. One of the reasons is that, I'm 56, I'm getting a little older, and that's important for me to keep an eye on is a little more stability. If you're a youngster out there and you want to keep, close to 100% of your investments in growth stocks, I can understand. Maybe observe it, and when you get a little older, you might start diversifying. But more power to you if you were heavily invested in the NASDAQ over the last couple of years because you're sitting on really good gains. And I hope that's the case for you. So that is Care Trust. Now, a couple of other companies that announced today that I wanted to cover. We've got Starbucks. So Starbucks is a company that's really had kind of a wild ride, wouldn't you say? Oh boy, this looks like the Grand Canyon. They were riding high, at the end of 2023. Then they just really, were they went off a cliff. And it did present a good opportunity for investors that kind of saw that this business was worth a lot more. Then they announced that, hey, we're going to hire this new CEO. He's a really good CEO that he comes over from Chipotle. He did a great job at Chipotle and the stock really rose. But since then, the stock hasn't done a whole lot. I think he's kind of come in, set expectations down, and kind of is trying to make it easy on himself so that a year from now, when they're comparing, hey, you've been there a year, what's your performance? So his compares are kind of reasonable, if you know what I mean. So let's take a look at where the company is at and what they announced and how the company is doing. I think that Starbucks is the leader in their category. It's premium coffee, very well recognized, all those things I like. It's a $110 billion company. Their PE isn't too high, 27 and 28. The dividend is pretty good at 2.5. Analysts think it's fairly priced, a little bit discounted. When we look at the growth, that's where I think investors have been really nervous is we're seeing that revenues are down a bit. And that's where I think the troubles begin. And that's where they hired the new CEO. The old CEO, I don't know that he got enough time to do what he wanted to do. But, it comes with the territory. When you get hired as a CEO, it's just sometimes you get a fair situation. Sometimes you don't. It's just the way it is. And this new CEO, he's coming in with a lot of, I would say, confidence that he can do it because he did it at Chipotle. I hope he does it, and for the sake of all the employees at Chipotle and the stockholders. And we'll see how he does. But that's really where the company is at, is how can they start growing the business? So I don't think I'm seeing the most recent quarter. So why don't we take a look at Starbucks investor page and see what they announced and what details are out there. Now I'm expecting this CEO is trying to I'm going to call it sandbag, lower the numbers so that a year from now, it's a little easier for him to compare and say, see, last year we were at this number. Now we're much bigger in revenue and so forth. But that's just my expectation. Maybe I'll be wrong. Let's take a look. All right. So consolidated net revenues in Q4 were down 3%. Okay. And then earnings per share of 80 cents. Okay. So revenue is down. That's not good. Comparable stores, same store sales declined 4%. That's not good. Okay. So same store sales is showing that, hey, we're not selling as much stuff in coffee at the stores we have. And overall, our revenue went down. So we couldn't catch up by raising prices. All right. So I'm seeing the theme there that we have a little bit lower revenue by 3%. Same store sales were not good. So those two things could be bad. And they pre-announced and told people that, hey, our earnings aren't going to be all that great this go around. And again, I think that the CEO is kind of making his own bed, meaning, he's going to be sleeping in it for a while and trying to lower the numbers so that people are expecting less and less. And then when he comes back and shows 10% growth, they're like, man, you're a genius. So I think that's what's going on at Starbucks. Can't blame the guy. I'd probably be doing the same thing if I was in his shoes. But Starbucks is a valuable company. I'm not a stockholder of Starbucks at this time. I've owned the stock, but currently I'm not in the stock. In general, it's a good, profitable company with very good margins, and they generate very good cash flow. Let me see if I can find a cash flow statement if they were willing to provide that level of detail. Balance sheet looks good. They decreased their cash a little bit. So they burned a little bit of cash. Long-term debt went up a little bit. So those are two small negatives. But here we are with the cash flow. This is what helps me value a company. And we're comparing the quarter versus the prior year, and they even compare it to 2 years ago. So That'll be interesting. So profit's been there in each year. When we look at so I'm trying to, so the formatting is a little tough, but here I found it. Okay. So cash from operations, it went from basically 6 billion last year to 6.1 billion this year. So a little improvement of maybe 1.5% on operating cash flow. And when we look at plant, property, and equipment, which is CapEx, it went up by over $400 million. So the cash flow, in effect, went down if you compare this quarter versus the quarter last year. So that's a little bit of a red flag. So revenue's down, same store sales are down, free cash flow is down. All right. Well, I think what investors are going to do is they're going to give this new CEO some time. They're going to give him a pass. I don't think the stock's going to sell off a whole bunch. It's just up a little bit, 0.54. I don't know if this new CEO is going to be just really, worth all the money they're paying him. We'll see in a couple quarters when we really start seeing the growth, and we'll see if he really does turn Starbucks around and maybe improves the market cap up to 200 billion, 250 billion. I sure hope so, because I think Starbucks is a great company. I'm going to give the stock maybe a quarter or two and see if I want to invest at that point. But for now, I think, they've got their hands full, and I'll see next quarter in 3 months how they're doing and see if I've changed my sentiment towards this stock. So this stock, I think, is going to continue to just operate and go sideways. I think if we look at from the time it really popped because of that CEO, it was at $95 a share. Now it's at 97. So it's been kind of going sideways. I don't expect that it's going to do anything other than that. But we'll see. It could surprise me, and the stock market can get really positive on the stock, or the flip side can get negative on the stock. So that is Starbucks. All right. So now we're going to go to Equinix. So Equinix is a data center company. And I thought it'd be interesting to cover a data center company because data centers have become really, really interesting with the AI build out. AI is going to need data centers, and data centers for companies to build out big applications, big workloads, and so forth. Now, Equinix is more of a real estate investment trust, I believe. Let's take a look at their structure. Equinix, world's leading digital infrastructure company. Equinix trusted platform to bring together and interconnect foundational infrastructure at software speed. Equinix enables organizations to access all the places, partners, possibility, agility, speed. Great. So it seems like, see, they're a REIT. They could have said that earlier in their description, but oh well. So they're a REIT. Great. Now, how have they done over the last 5 years? So over the last 5 years, they're up 60%. Over the last year, they're up 28%. So CTRE, and I'm willing to bet that Shadow Guys OHI actually did better over the last year. So what I'd be curious to see is, okay, so all this hype around AI, is it really leading to dollar signs for these data centers? Well, if we look at the total revenue, we have seen an increase, which is really good. From 2022 is 6.7 billion up to 7.7 billion. Then trailing 12 months is 8 billion. So that's pretty good revenue growth. 15% is pretty good for a REIT. So that looks really good. How come the stock hasn't flourished even better? Maybe because operating costs are really high? Could be. Yeah, the operating costs are pretty high. So maybe it's kind of a cool place to operate in, but this operating cost is really taking a lot of this revenue and giving them very little operating income. In fact, once you look at interest expense, there's a negative. Seeing if they're profitable. Yeah, they were profitable. So good and profitable real estate investment trust. Let's take a look at their funds from operations. So funds from operations, 2.1 billion. in 2023, and it looks like the trailing 12 months is even better. And if we look at their payout, 22.66 per share, they pay a dividend of 17, so they can afford that dividend. No problem affording the dividend, but it is kind of a low dividend, right? You buy a REIT because you want that income, and having a REIT that pays 1.87 is kind of like something wrong with that. They should increase the dividend, because investors in REITs, in my opinion, are investing for income. If you want a high growth stock, you would go buy a technology stock or some related, disruptive stock that's really going to do well. Maybe a new financial services company that's a disruptor. So that's kind of a mixed situation. It's an interesting company and an interesting space, but the fundamentals don't look great. That's a low dividend rate. All right, so that's bad. Now, I'm curious to see what their financials have to say. I haven't looked at them, so let's take a look at them together, because one of the things that I'm following is how real is the AI build out? And I'm the first one to say that AI is really interesting. I really have fun on Meta AI and Gemini, and I think that AI is going to certainly be a benefit to companies, to individuals, but I just don't see it really around me just yet. The iPhone's supposed to have Apple Intelligence, and it sounds kind of gimmicky to me. And then Google's released it with their Android. Well, I haven't heard that people are like just beside themselves on how cool that is. Haven't heard that, but maybe I haven't been paying attention. All right, so this is where the rubber hits the road, right? The data center. If AI is supposed to be as big as it's claimed to be, these data centers should be really growing. Like, oh my God, we doubled our capacity overnight because we have so much demand. So let's read this together. So Equinix reports third quarter results. Record gross bookings. Okay. So quarterly revenues increased 7%. Well, 7% is nowhere near disruptive. It's like, okay, big deal. CTRE grew that much, and they're just housing, older people that need some healthcare. All right. So try not to be cynical about it. All right. So, of course, they have to mix in some AI in here. And I think they're trying to mix this in so people go, wow, you're AI, so you must be worth 5 times as much money as you really are being traded for. But really, I'm a little bit of I want to see the fundamentals, and an increase of 7%. I mean, we've been in this AI thing for 2 years. And at the beginning, I'm like, whoa, is this going to be a fad or is it going to be real? How quickly are we going to get there? And, 7% growth 2 years later, to me, is like a disappointment. You should be growing at 25%, 30, 45%, something like that. Then it'd be like, whoa, yeah, man, AI is getting built out left and right. So that's interesting. All right, so let's move on. So third quarter 2024 results, revenues, a 2% increase over the previous quarter sequentially. So they grew 7% if you compare to last year. If you compare it to the previous quarter, 2% sequential growth. That's nothing. Again, it's like, wah, wah, wah. Not impressive. All right. So top line's not growing, and they're not paying a big dividend. So I would like to see Equinix pay a better dividend, and if they can, raise their prices, because it seems like they're spending a lot of money on their properties to have data centers, and they're not keeping as much in the form of profit. So Equinix, although they're in a cool area of the market right now, I don't think is going to receive any of my dollars to invest in. The market is selling them off a bit, and I wanted to take a peek just because, To understand the AI investing story, I'd like to look at different points of view. This is the point of view of the data center. This is where it's supposed to be being built out. So why isn't it growing that fast? Leads me to think, well, that's interesting. Now, as a counterpoint, if you look at Microsoft, they grew their cloud business very, very well by 20%. That was a big growth. If you look at Google Alphabet, they grew their cloud business tremendously as well. Those two data points say that AI is real, that they're really selling more services for companies to use AI applications and solutions or build AI solutions, large language models. So we'll continue to see what's going on with this AI story, and how can we make money or how can we avoid losing money. I was a part of the the internet, the pre-internet economy, the dot-com economy, and the post-dot-com economy. I was an investor. I was professionally employed and saw firsthand some things that were really gimmicky that went away. Those businesses really didn't exist after the dot-com bubble, but they also heavily discounted great companies like Google, Amazon, Microsoft. These companies are worth so much more. Apple, they're worth so much more money because the market just, sold everything off. So there's an opportunity to make money in every market, but I like to understand high level, kind of like the complete picture so that I can form long-term investment ideas that over the long haul I make a lot of money on. I'm not a short-term stock investor. I think that's somebody else's game and they probably do it well and make money. And I certainly hope that's the case. But I think I play with my strengths, and that's where I think I could do a little better. When it comes to the AI build out, I continue to think that I'm going to be careful. I'm going to pick obvious winners like Google Alphabet, Meta, and ride those horses, because I think if there is a kind of a sell-off, like a dot-com bubble bursting kind of event for AI, I don't think I'm going to get that hurt being in Meta and Google Alphabet and companies that I think are going to resist a big meltdown in that space. Speaking of which, we had a huge meltdown in Super Micro Computer, and that's a stock that unfortunately just got taken to the cleaners today, down 32%. And I feel for all investors of Super Micro, but this story was a little too hard to believe. If you look at a stock that does this, right, you're like, whoa, did they cure cancer? Did they figure out how to, travel at the speed of light? What was incredible about them? And when I find out that they're a hardware company, I've been an investor in hardware companies for 30 years. I've invested in Sun Microsystems in the late 90s. Okay. So I've been there and understand that hardware companies do not have a lot of intrinsic value. So for a company to really go up in value like Supermicro, I really doubted the fundamentals and felt strongly about it. I shorted the stock. I made money on it. I sold it, but I was not in a short position when this happened. Obviously, it would have been nice to be short, Super Microcomputer today, but I made money. I didn't get greedy and I got out of that position. But today, this was really, really, really bad. Now, this is one of the not one of the big players in AI. This is one of the sparkling little stars that came out of the AI build out, and it looks like they're in a lot of problems. To lose your public accounting firm is so bad. It's just who's going to do their accounting? Which other accounting firm is going to step in and say, yeah, we'll take the liability of potentially, and this is all potentially, fraud being committed or financials being misrepresented. Public accounting firms will pay a dear price if they're involved in that. I cited that in the early live stream today. Arthur Andersen doesn't exist anymore. They were the biggest public accounting firm in the United States. And after they were involved with Enron, which was proven that they were making up their financials, they were deemed to be a participant in that fraud and therefore would not be allowed to ever operate as a public accounting firm. They had hundreds of thousands of employees, and overnight they were like, you may not be a public accounting firm. Now, all those folks were skilled and they were able to move to other firms and in some cases take their clients with them. So that was a big shuffling, but the fact remains Arthur Andersen is no longer a public accounting firm. So when you look at a super micro computer, which accounting firm is going to subject themselves to that type of risk? I think they're going to be very careful in interviewing Supermicro, and whomever is going to be their public accounting firm, I'm sure is going to take all the precautions and probably look at their financials with a fine-tooth comb to make sure everything is square and on the up and up and clearly represented. Very important. So good luck to Supermicro. I do not like seeing businesses go bankrupt because there's a lot of employees that get disrupted and there's stockholders that lose money. So good luck, Supermicro. All right. So I wanted to look at a couple more companies. I wanted to look at Amgen. And Amgen announced today, Amgen is truly a biotech company. These guys have a lot of treatments for human illnesses and so forth. They operate in California. That's where I'm at. I'm a fan of the company because they created themselves and just have become a really, really world-class operation that's worth $169 billion. And the company has $30 billion of revenue. Their PE next year is going to be really low at 15, but this year it's pretty high at 54. What's going on at Amgen? Now, over the last 5 years, it's up 51%. Not bad, especially since you're getting paid that dividend. I think once you compound that dividend, you're probably up at 65% total return. Not bad. That is not bad at all. Over the past year, 20% plus your dividend, you're up to 23% collectively. You're good to go. That's a nice investment. Now, how have they done as a business? So they've been growing nicely. It's green on the screen, especially the trailing 12 months. I see nice growth there. Man, the last quarter, 20%. Go Amgen. These guys are cooking with gas. Very good. So I haven't looked at Amgen in a long time. So I like what I'm seeing. Their gross profit's good. If you look at 8.3 billion, but they get to keep 5.1 billion in the form of gross profit. That's probably in the neighborhood of 60%-ish. And that's pretty good. That's pretty damn good. So that looks good. Now, I'm not seeing their release numbers today, so I'd like to take a peek at those. But before I do that, let's take a look at their cash and see if they've been a consistent cash generating company. And it's been a little up and down. It's been nice for a couple of years, down for a couple of years, but the trailing 12 months look pretty good at 2.2 billion. Now, 2.2 billion, and if I look at their market cap, wow, that's a big letdown because you're paying upwards of 80 times free cash flow for the company. That is not a good deal. I can show you Microsoft. You're not paying that much for Microsoft. Let's take a look at Microsoft. And we know Microsoft's awesome. We know Microsoft's great. Now, this is a big market cap, 3.2 trillion. But what are we looking at from a free cash flow from this awesome company? Free cash flow, it's always been excellent. And we're going to use 74. So if you take 3.2 billion divided by 74, we're going to get to about 40 times free cash flow, which is better than our friends over at Amgen. And if I showed you Meta, it would be better. Meta is probably like 30 times free cash flow. My point being is that Amgen's a good business, but it might be a little too expensive because my principal valuation method is based on free cash flows. And the reason I use that is because a lot of the successful long-term investors, Warren Buffett, Charlie Munger, I can go down the list. They use free cash flow. Free cash flow is one of the most important factors of valuing a company. intrinsically if you're going to be a long-term investor. So with that, I think I'm going to stop my analysis of Amgen and say, yeah, this one's not the right investment for me. I'm looking for companies, and I know of other companies like Pfizer, even Novartis. We evaluated Novartis on Monday, I believe. They have better fundamentals than Amgen. So I'm going to pass on Amgen. Wish everybody who's an investor in Amgen good luck, but it's not the right investment for me. Investors are buying into the stock in the after hours of trading, and that's because Amgen posted higher quarterly profit and sales rise 24%. Good for them. They are growing their revenue. That's great. But I want to see that cash. If you can consistently generate cash and you can grow your cash, you're golden. That's what I'm looking for. I'm not seeing that in Amgen. So for now, I'm going to pass and wish everybody good luck with the stock. All right. So we are heading toward Booking. And I did do a little extra homework on Booking because I'm an Airbnb stock holder. And I got a few things that were eye-opening to me. So Booking, if my facts are correct, it was kind of a merger between what was a company in Europe by the name of Booking.com and Priceline. Priceline was historically a travel site here in the US, and they combined, I forgot who bought who or how they merged, but they kept the name Booking. I think it was a good idea. I like the name. And they're basically a travel site that also competes in the short-term rental business, competing against Airbnb, because Airbnb, along with other companies, created this space where you have short-term rentals where people rent out a part of their home. They can either rent a bedroom or they can rent the whole home and the whole property, which is my preference. When I stay somewhere, I stay in an Airbnb and rent the whole place. I have rented, on one occasion, I rented one bedroom. And it was a pretty cool setup. It was in San Francisco. And San Francisco has banned short-term rentals. But in this case here, your bedroom had its own lock. I had my own bathroom and stuff. So it was pretty much like a hotel room. And it was a good experience overall. Now, Booking announced they are doing well after hours. One thing I'll point out, this stock's really worked for the past year, up 62%. Congratulations, Booking Holdings stockholders. You're rocking and rolling. And they pay a little dividend. So a little cherry on top of that 62% gain. That's been really nice for them. Now, their market cap's 149 billion, revenue 22 billion. They have very good margins, as I'll show you in a bit. Their margins are pretty exaggerated because their cost of revenue isn't all that high. It's not like they're operating the properties. They're just renting them out and making a margin. And the revenue is 22.3 billion in the trailing 12 months. They get to keep almost 19 billion. That's awesome. That's above 80% gross profit. Great job. Very good. Now, when it comes to cash flow, they could do a little better there. I think Airbnb is a little better than Booking. When you look at the cash flow that they produce, for some reason, you get away from that gross profit, and they have a lot of cost in between gross profit and net income. And that's been shrinking the amount of free cash flow. Now, if I took this 7.5, multiplied it times 30, I'd get to roughly about 225 billion. And that puts, and I'd have to take away debt. So let me do that real quick and see how much their debt is. So their debt is, so cash 16, and I think debt's about the same. So it doesn't have a factor at all. Yeah. So they have as much cash as they do debt. So really, you could see this stock continue to go up because their free cash flow is attractive. And if you multiply it times 30, you get to like 225 or so. So you still got some more room to the upside on bookings. So this has been a winning stock, and travel has really been really doing well for the last 2 years, maybe 3, because when we were cooped up during COVID, everybody couldn't wait to travel, and they certainly did so. Travel in Europe has just been off the charts, record breaking, to the point where European people, permanent residents there, are kind of getting fed up with so many tourists. They're actually really expressing their frustration with that. But hopefully it levels off and everybody kind of gets what they need. The residents get their communities to be okay. They make the money, they make the tax income to keep their economies really doing well. So bookings doing really well. The earnings were positive. Let's take a look at some of their highlights. And I don't know if this one's about their okay. So I don't see their earnings announcement there. So let me go to their site. All right, here we go. So, and it's saying that they're headquartered in Norwalk, Connecticut, but I know that Booking itself is a Dutch company. And 12 years ago, I owned 2 short-term rental properties and I did do business with Booking. So I remember our contracts were with a company that was headquartered in the Netherlands, and that's why I know that. I also did business with Airbnb. So, so the company, their nights booked went up 8%. Looks good. Total revenues went up 9% from the prior year quarter. So that's year over year. Okay. So that doesn't match the growth rate they had earlier. I think we were at a higher growth rate. Yeah, we're at 15 billion. And you see that there's a little bit of a slowdown. We had this boom in travel. You see these numbers, 40%, 27, and we're seeing a slowdown, 7% in Q2. Then Q3 looks like it is 9%. So we're seeing that slow down. What's that going to do to the company? I don't know. And if the company doesn't grow, then my valuation changes, right? I'm not multiplying that 7.5 billion times 30. Maybe I'm multiplying it times 20, and then it would be fairly priced. If they're not growing at 20%, I'd probably be more in favor of valuing the company at around $150 billion. So this company is slowing down their growth. Understandably, they grew really, really well for the last 2-3 years. So that is understandable. All right, so that's where Booking is reporting. Now, this has been a winning stock, and investors have benefited from it. So it looks like they're buying into the stock. Can't blame them. I think it's a solid company, and if they come up with some new ideas on how to grow, and they can, get back to that double-digit growth, that'll be important for them to continue to be a growth stock and continue to have this valuation. Now, what I thought would be interesting is let's compare these two companies, Booking and Airbnb. Now, I'm an investor in Airbnb. So I've known that Airbnb, for some reason, sold off, and I can kind of retrace what happened and what I'm going to expect. So if we go for the 1 year, these two stocks were pretty much aligned. They were kind of together, but in May, they kind of became separated. Booking began, their stock price performed better from an appreciation standpoint than Airbnb, and it stayed better up until now, considerably better. If you look at the 1 year, Booking is up 60%, where Airbnb is only up 16%, which is disappointing. I must admit, I own like $100,000 of stock in Airbnb, so I can tell you that I would like to have seen them operate a little closer to that Booking stock price. But welcome to investing. We don't always get what we want, right? Now, what I would say is Airbnb is going to announce next week on the 7th, so a week from tomorrow. And what the market, the market is at times unpredictable. You look at Apple, they haven't been growing their business for 2 years, and the market gives them a complete pass. It's like they're not growing, and they're still like this massively valued company. At what point are people going to say Apple's not growing, and they're probably not going to grow? But that's an observation. Airbnb announced at the end of Q2 and they said, hey, this quarter is going to be light, but Q3 is going to be off the charts because the Olympics in France were housing more than 400,000 people. Everything is saying that Q3 is going to be off the charts. And the market ignored that and sold off the stock. And that's where we saw this. Okay. Now, I didn't forget. So I've been holding my shares, and I've owned Airbnb not when they IPO'd, but probably 6 to 9 months after they IPO'd. So I've owned the stock for a little while, really believe in the business, and believe that when they announce, they're going to announce really good news. And I'm expecting that stock will begin to track upward. I believe the Airbnb business is purely a disruptor company that is not based on legacy business models. It's based on new business models, which is the sharing economy, where private property owners get to rent out a property, a vacation property they have, something like that. And now Airbnb is doing experiences. So I believe that model, the sharing economy, like YouTube, where people come in, create content and share it with people, where you have, Spotify, having people come in and paying a subscription, getting the music they want. That type of economy in the connected world is where you're going to see good organic growth. And I believe Airbnb is aligned with that quite well strategically. So I'll continue to own my shares in Airbnb because I truly believe that their future is the brightest when it comes to travel. But for now, I would have to tip my hat to the Booking stockholders and say, you had a way better year than Airbnb stockholders. So good luck, and we'll see what happens. So that is Booking. They're having a good night. They're having a great year. So those are the big names. We went over Starbucks, Booking, Equinix, Meta, Microsoft. This morning I went over Eli Lilly, AbbVie, Caterpillar. I went over ADP. I did not go over ADP, but I intended on doing that. I ran out of time. I think some attendees wanted to look at some stocks, and I looked at them. Now, I think, let me double check to see if there are any requests. Let's take a peek at OHI and see what Shadow Guy is invested in. So that's Omega Healthcare Investors, up nicely, 29%. So 29% up, and it pays a 6% dividend. So collectively, you're up 35%. Very good. Smaller market cap. So that looks good. And I imagine they have funds from operations. So that looks really good. So Android PC, you're holding Airbnb. I'm right there with you, and you're still in Intel. Man, I hope Intel it really turns the tide and starts going up. It's just such an historic brand, an important brand. I'm hoping that they get their act together, kind of like General Electric. They had a lot of problems, and it was a really historic brand in US. And now GE is doing great. Intel, I hope, has the same forward path. But boy, I've been disappointed in Intel this year. I was really disappointed that they couldn't pre-guide their number going into that earnings. And now, I mean, all the stories of them being sold to Qualcomm, of them splitting up into 3 pieces, all kinds of weird behavior. They hired a firm to help them against any of these big investors that come in and try to, form a new strategy for the company. I forget the term they use, but all that behavior to me is like, just fix Intel, figure out how to make semiconductors that are super valuable, grow your PC business, figure out how to grow and then stick to that plan. Don't make a bunch of pie in the sky plans that don't ever happen, because that's where you lose everybody's confidence, which is the case right now. I don't think anybody believes in Intel. I would like them to do better because, they've been a really important company in our economy for the last 30 years, if not 40. So good luck to Intel. I hope you triple your money on Intel over the next 5 years. So So that's my live stream for today, man. It's plenty to talk about this week. Holy smokes. We've got earnings from big, massive companies. Super interesting information coming out of the market. Let's see if the market's telling us what the future has in store for us. And I don't know how accurate this is. Futures is kind of trading down a little bit. NASDAQ futures is down. S&P is down. You can never trust these metrics, right? Because for all we know, we're going to open up higher. Let's take a look at Meta and Microsoft, which will really be bellwethers for the market. And yeah, I can understand the market going down. If Microsoft goes down 4%, and again, I think their earnings were very good. Maybe there's just sentiment out there where people just want to sell right now, wait till after the election and come back. Maybe. And let's see what Meta's doing. And Meta's down. So ditto, right? Like, I think Meta's earnings just show that how freaking strong they are and how profitable they are and how good they are. So tomorrow I'll buy 1 or 2 shares of Meta, just put a little more money into this awesome company. It's already my biggest stock, and I got to be careful not to get too far into Meta, but I own $257,000 of the stock. So I got to be careful. It's my biggest holding. I could buy more Google Alphabet. I've been buying into Google Alphabet, and kind of those are my two, man, those suckers. I mean, that's an obvious winner, those two. And again, Microsoft's an awesome company, but I need to pick between Google Alphabet and Microsoft. And I've decided Google Alphabet has the best future, in my opinion. And that's the one that I'm going to ride. So that is the live stream for today, guys. And, really appreciate you tuning in. Please consider being a paid member. I will work very hard to try to make it worth 10 times your monthly fee in the form of doing workshops on the weekends where they've been really good, really good. If you're a young investor, a new investor that maybe is forming a new strategy, maybe you're 30 something, 40 something, you want to wake up in 20 years with a couple million bucks. Really important to learn good, solid investing strategy, good investing process, and then go do it and wake up 20 years from now with $3, $4, $5, $6 million in net worth and really be financially free. It doesn't happen magically. It happens through learning, investing right, being patient, and betting on the right companies. And that's what we talk about as investors. The community brings together, if anything, just good experience, other people investing in stocks, and they can cite their successes and their failures. And we can all, learn from that. Most of the time it's success. We've seen a lot of appreciation over the last 2 years. So if you want to be a part of that completely, consider being a community member. And it'd be great if you do. And that's the information on the screen. And you can also get it in the details of the live stream. So everybody have a terrific evening. Get a good night's sleep because it continues tomorrow. We're not done. This is just going to keep going. The train keeps going. Where is this train headed, man? We've been traveling mile after mile. Well, buckle up, kids. Tomorrow, Apple, Amazon. Whew. Man, that's going to be awesome. MasterCard, Merck, Shell, Uber. Woohoo! Before the market opens. I love Uber. Comcast, Total. This is the French oil company. Eaton, which is an industrial stock. Hey, Anheuser-Busch, Conoco. I mean, we got earnings coming out of our ears. Cigna. Holy smokes. Too much to handle. It should be really interesting. So I'll try to live stream in the morning. I'm pretty sure I'm going to live stream in the morning. And we will be sure to cover Apple, Amazon. And then in the afternoon, I bought a costume for a Halloween party. I might wear it for the evening live stream like we did this evening. We'll see. We'll see. I don't want to look too ridiculous, but we'll see. I'll make a judgment call, game time decision. But it should be another really interesting day, guys. And I hope all your stocks are doing awesome. You're making lots of money. Tune in tomorrow if you'd like to hear about these companies. And if you have any suggestions, please go on the chat of this live stream. I'll read any comments you make, even after the fact. Or get on Discord. We have an awesome Discord going where we are sharing all kinds of good information. Let me try to show the Discord information real quick. So this also is in the details of the live stream, but this Discord server has really been an interesting place where a variety of investors that I think we all agree we're long-term investors. We're not traders, although we have a couple of traders that come into the Discord. And I like that that's the case. That way they give us their point of view, but predominantly it's long-term investors. And we have investors that are young. We have investors that are middle-aged. We have investors that are a little older. And I think you can probably see some examples that are, if anything, just good to read and understand. Hey, that's what that investor is into. These are reasons for it. And this is their experience. Nothing of everything we ever talk about is ever financial advice. I never recommend you buy, hold, or sell any stock. I'm just sharing my experience because I think that in itself is interesting to investors and could be a learning exercise for many. As I look back, when I was 20 something, we didn't have YouTube. It was a very lonely task, which was investing. You do it on your own. You'd read books, you'd buy stocks and just wait, and you couldn't talk to people about it. But now we're in the golden age of investing. You can say, hey, I'm thinking of investing in this stock and these are the reasons for it. Maybe put it out there on Discord and see what people say. And maybe somebody can share an experience that's useful to you. And that is awesome. I think that's great. If anything, it just makes the experience of investing more pleasant, more interesting. We're not alone. I mean, I've been chatting with Android PC guy for a while, Omar. Shadow Guy is one of my buddies, and I talk to him just about every day. So all this stuff, I think we're in the golden age of investing, and you can be as involved as you would like to be. So everybody, thanks for tuning in. Really appreciate you. Everybody have a very pleasant night, and I will talk to you soon.